So this is what we're going to talk about. We're going to talk about the difference between trending markets, which will often be called expansion, and range-bound markets, which will often be called bracketing or bracket markets. These two second terms are more the auction market theory terminology, and the first two are more the price action, or standard view on things. I use both interchangeably. That's why we're going to label both in this instance. So what we're going to talk about today is how to view trends and how to view ranges, how to view the transitions between the two, and then how to trade them. This is incredibly important for discretionary traders, because not properly understanding what we're covering today is one of the key things that is chopping people up and making them lose money unnecessarily. So getting a decent grasp of this stuff will help you not only know when to bet on things properly, but how to bet on things. And the most important bit around it all is how to avoid dog shit bets, because that's, really one of the key things that's hurting people. I'm sure a lot of you guys can get in positions and make money here and there, but your losses are probably, almost outsized and are really hurting your equity curve. So really soak up this lesson today, because this is going to be really helpful for anybody that's a discretionary trader. And frankly, even if you're an algo trader, this is one of the main things that's going to fuck your bot as well. So you can literally, with discretion, have a momentum system and have a reversion system, and then turn the bot on and off when it's the right moment. All right, gotta drink more water. We got dry mouth because I'm talking so much. Okay, so we're gonna keep everything pretty simple today. Again, like I said, this is I'm not covering everything. I'm just covering what I feel like covering, to be honest. So there's still some censoring going on here. So, first rule, and the most important rule: when you are in the range, before we get to that, if a basic cycle in markets is a range into an expansion, range, continuation, right? This is the basic principle of how I view trends, right? It works both ways. Let's go ahead and invert it. It works the same way to the downside. This would be 2022, and this is 2023. It's the same logic, whether it's up or down, how we're going to gamble on this. So first thing that we're going to cover is that anticipating when you're in the range, when are you going to break from the range and begin the expansion? This is something that you will almost never be able to guess. It is very, very difficult. But when you're in the expansion and you want to anticipate when you're going to transition into the range, you can actually do that pretty reliably. So that's the first kind of lesson, is that when you're in the range, you play the range. You don't try to bet on expansion when you're in the range. We'll talk about how to do that later. So you really, when you're in the range, just trade the range. That means you trade into the range lows. You want to be long biased, right? You want to view this like a distribution curve and say that this is the mean of the range, and that when we're into these upper points, we're expensive, and when we're in these lower points, we're cheap currently. And you want to play reversion back to the midpoint when you're in these periods. This is kind of one of the most important things. This is probably 80 to 85% of the market, excuse how disgusting that is this. So getting comfortable with this idea is really important. If you want to be a lower time frame trader, this is not where you're going to make your money as a lower time frame trader. It's in the ranges. Let's delete all this so that we can see everything more clearly again. So that's one of the key, really important bits here. When you're in the range, you trade the range. You do not try to anticipate the transition from range to expansion. You're basically not going to be able to do that without a lot of experience. How you want to trade expansion when you're in the range is you need to understand which way the trend is moving and bet at the opposing side of value. So if the trend is up, that means that if we're trading right here and I want to bet on upwards continuation, you don't long right here because you're going to get chopped, okay? Where do you bet on expansion when you're in a range? over here. You bet as low as possible on the range because your risk is defined, and because of that, you're betting. If you consider the fact that you're betting on the trend and you're betting in a area that is your risk to reward is defined, now your expectancy is actually positive. If you bet on trend expansion right here, your expectancy is not positive because you are not, if when the price trades down into this region, you are going to puke, right? You're either, your stop losses are going to get triggered, or you're going to manually close out because you can't stomach the drawdown. Okay, so that's how you want to play that stuff. Let's go ahead and get into some of the other notes. So we covered that you're likely not going to be able, when you're in the range, you are likely not going to be able to say, we're going to expand tomorrow. You're not going to be able to do that. But what you can do pretty reliably is guess when we're in a trend, when is the range going to start to form? It's far easier to anticipate when a trend is fading and the range is starting to form. So now this does require, absolutely is going to require experience just the same, but you can do it more likely, your probabilities are much higher based off of these kind of things that you can point out. So step one, which is going to be the easiest thing for you guys to identify, is going to be swing points. So when you're in a trend and you're trending up, you're going to identify the swing points. If this is what price looks like, now I have a swing high and a swing low. Now this is what I anticipate my range to roughly form based off of, is this. Okay, so that's one, is identify the swing points or the anomalies, right? So anomalies being things like, single prints would be one of the most important things I would use, right? So if you get a big expansion, if you're in the process of expanding upwards and you get a nice void and then you have your swing points that you can move from, you expect that the singles are going to hold as support. So this is basically where you would want to gamble on the range low forming. And you would, so hopefully that makes sense. Identify swing points and anomalies. The next piece is going to be around volatility. Volatility is a very useful tool for gauging expansion and reversion. When volatility, you're in a trend and volatility starts to die, you're far more likely to be beginning the ranging process. Next is going to be around derivative flows and liquidity. So for derivatives being your perps, right? Your perps, we don't really need to factor futures into this because they don't really matter for what we're talking about. This is mainly going to be perpetuals. For perpetual for makers and takers, here's what you want to pay attention to. For one, you want to pay attention to, so we'll do the takers first. So one is takers, just T for takers. Takers should be exhausting and starting to give up. Once the takers are not clearly in control, what that looks like is if people are market buying, is price continuing to go up? So are people market buying and is price not going up anymore? And are these market buyers hitting the tape less frequently and with smaller size? So that's essentially what exhaustion is going to look like. So when the takers start to lose, you're far more likely to enter the range. And here's some spice as well. The other bit is not just about takers, it's also about makers. During expansion, market makers are not going to be providing that much liquidity in the book. It's going to be thin because market makers' primary job is to not get run over. So market makers say, oh, you guys want a trend? Peace. We're out of here. I know you guys have all seen that before. You've seen people go on Twitter that cry about how the market makers aren't providing liquidity. They're doing a bad job. No, they're doing their job exactly how they're supposed to, which their job is to survive and not let retards like us run them over. If a market maker holds the line and tries to soak idiot flow, they die. That's how market makers get rinsed and get completely wiped. So what I'm getting at is that when the market makers start to repopulate the book again, so when orders start to get thick, this is probably a sign that the trend is dying and that the range is beginning to form, because market makers are going to be the thickest in the range. Next, spot flows. So this is going to be definitely something that's going to require more experience, but essentially reading how the spot flows are taking place is going to also be a good sign, because at the end of the day, we can view it like this, that most of the price action in the range is going to be derived from perpetuals, right? The perpetuals, all the apes that go in 50x leverage and all the people that are gambling all day long in the range, most of the directional price movement is from perps. Okay, but the trends are more likely going to be resolving because of spot flows, right? So people providing liquidity in the spot books and people taking from that liquidity. That is actually what is one of the large drivers of trends, because if a trend is not supported by spot, if it's not supported by the underlying, then it is far more likely that it won't actually be a trend. So think back to price action like we had in, this is imagine this is the 31K range that we just broke out of. Look at this range and look at price action in 2019. You get a lot of price action where you drift up, shorts start to close, you go up a lot, and then you go right back down. So if spot was actually supportive of this up move and it wasn't just off the back of shorts closing out, then the price would have continued to go up. Because there's no support from spot, you get the Burj Khalifa. So that's how you either get the Burj Khalifa or you get the BARTs, where the BART was go up, make the BART head, and go back down, right? These are attempts at where there's part of the market is trying to trend during 1 and 2, and there's no support from spot. So you go right back down to fair value again. Okay, that's that. The last bit we're going to cover is going to be around time. So this is probably the most discretionary out of all these concepts here, but essentially, I'm not going to fully explain this because I don't want to give away one of my time edges, but essentially you want to factor in time. How much time is being spent at this price. Time plus volatility is a key discretionary tool that you can use for anticipating what we are discussing right now. Okay, the last thing that we're going to be covering, and we already kind of covered this, but we'll touch on it a little bit more. Okay, so we just covered how to anticipate the trend dying and beginning to form a range. Now we're going to cover moving from the range to the trend, which, again, to reiterate that this point that I've made several times already, you are not going to do this consistently. It is very, 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 very difficult. Requires a lot of experience and, frankly, luck as well. Absolutely. So in order to move from the range to the trend, basically the answer is clean positioning. Because like we talked about at the very beginning of this breakdown, this is the main thing that will chop you up. When you're in the range and you try to bet on trend expansion, right? Like this 31K range, right? How many people tried to short the breakdown and how many people actually caught it, right? A lot of people tried to catch that short and got chopped up in the process because they're shorting in the middle of the range, right? Or they're shorting in the range lows, right? Any of these, you short at the mid range, you short at the range lows, good fucking luck. Because what's going to happen? It's going to revert on you 9 times out of 10. So the argument is around clean positioning. If you are in a range and you want to bet on upwards continuation, you need to get long in the range lows. Because even if your probability of being correct isn't right, you end up being wrong, and it just comes back. Let's say you long this and it comes back up and then gets bonked back down. You have breathing room in your trade. So that's pretty much the bit that we're trying to say. If you're in a range and you want to bet on it breaking down, you need to get positioned as high into the range as possible, because even if you're wrong, it's going to provide you breathing room to ideally lock in a small win, even though you're wrong, and most importantly, not get destroyed, right? Because if you want to catch this short and you're opening your short down here, what happens when it comes back up to mid-range? Are you going to hold on to that short? What happens when it comes back up to the range high? I already know what's going to happen. When we come up to the range high, you're going to get fucking scared, right? And you're probably going to close it out, and then it's probably going to come back to the mid-range again, right? Because this is what ranges do. All right, everybody. That is it. For more information, check out the Paragon group with the link below, where I cover everything from how I trade to how you can develop your own style.